Well, I did accountancy, and when I qualified as an accountant, I was always heading towards the financial markets, and I ended up back in Dublin, having had a year or two abroad in NCB stockbrokers, and I had a couple of years out in Neil Starr, out in BlackRock, the fund managers, and then I went back to NCB and the equity research side, and then I left in 1999 when there was a group of us leaving to set up Merion stockbrokers, and I headed up research in Merion for several years before running a fund myself in Merion, an equity fund. And when Merion was bought out, then I moved on in early 2009. Well, I'm the founder of the Investor Centre, which is a website dedicated to the retail investor, to provide the ordinary investor who wants to do it himself with all the tools he needs to invest in the stock markets and control risk. And I provide a weekly investment bulletin which helps them understand what is going on in markets. I provide analysis of funds across all the asset classes, and I provide stock picking systems all on the one site. And I package that then in a section of the website called the Model Investment Portfolio, where I do the asset allocation process for somebody who'd like to manage their own money, whether it's pension fund money or just their savings in a risk controlled environment. My own is naturally a value style, and so I would gravitate to values when given any chance. I don't tend to be a trend investor. I don't tend to be a trader or a speculator, so I tend to gravitate towards values with the understanding that values are not absolute, and you do have to compromise in that in very low interest rate environments you have to be prepared to be somewhat more lenient with your values, and when interest rates start rising that you have to be more careful. So I think values is the key, and it comes in many different ways, as you well know. Not on the buy side. I tend to be quite, I tend to feel that asset classes are reasonably valued. You can't value commodities. It's either a thing you believe in or it isn't. You can certainly value mining companies if you try, but whether you can say the earnings in those mining companies are sustainable or not, I don't think anyone can. So outside the asset classes of private equities, property, I think bonds is what I tend to feel is the asset class I have the strongest view on, and I just feel there's absolutely no value on them. I look at the US 10-year bond, which is yielding about 3.3%, and that's something that's probably about the same as Coca-Cola. Coca-Cola yields about 3%, except that Coca-Cola has no debt, and the US government has 100% debt, and they've negative cash flow, whereas Coca-Cola has massively positive cash flow. And that dividend that Coca-Cola is giving you is probably rising by about 6 to 7% per annum because their earnings are growing and they have emerging markets exposure. And the US economy is struggling to grow. So in terms of the comparing something to a bond, I find it very easy. Equities, certainly defensive equities with decent yields are a hell of a lot more attractive than a government bond. I don't see a massive inflation scare myself because people are paying down debt. And I have to say I'm in between whether I'm scared of inflation or not. I'm in between. I can understand both arguments, and they're both quite persuasive. And so I don't have a strong view on it. I think if inflation picks up, it'll be a couple of years down the line. I think if interest rates are rising with the level of debt that's around, I don't see them rising all that much. They don't have to rise all that much. And in that environment, I don't believe rising interest rates up to 4 or 5% is going to be a great threat to equities or indeed property. So I think equities and property will withstand a couple of interest rate rises. I'm unsure about the commodity cycle myself. I find it hard because I find it hard to value commodities. They don't have an income, so it's demand supply. And I'm most unsure about whether, if we do have rampant inflation, I'm unsure whether commodities are actually a good hedge or not, because as far as I'm concerned, in the last 10 years commodities have been very correlated to equities, and I don't really see that changing. I think the overall common factor in driving asset prices has been the amount of excess liquidity in the global economy. And I think that has pushed commodities as much as anything else. I do understand the China, India story, the population growth, the demographics, etc., etc. But I don't necessarily buy it, hook, line and sinker. So, you know, on an uptick on inflation, where would I be? I think equities and property will be a reasonable place to be. I don't see rampant inflation. No, not necessarily. I tend to believe on the gold thing that it's the analogy I use is the old Meatloaf song, two out of three ain't bad, in that central banks will be buyers of gold for the next 20 years in my view. They have made a major mistake to have the reserves in dollars, and gold is the most liquid asset outside US treasuries. So I believe central banks will raise their gold reserves from tiny levels to more substantial levels. I think that's a very strong underpinning of demand. I believe gold is the only currency that you can truly say is not going to be debased. And the third angle, which is a negative angle, is that gold is not a cheap asset. If I compare gold to long-term inflationary trends, under my framework that I use, it's probably some 130% above the trend. Now, when the gold price peaked back in 1980, in the last real bull market blow-off in gold, the gold price was 180% above the trend. So I think we probably have a little bit to go. But if you're worried about solvency and the solvency of currencies, then I think gold is a natural asset class to have on board against currency depreciation. I don't know that gold competes with equities and property. I just believe it's a natural hedge to currencies that are being printed. Well, you know, I always, there's different markets, and I always try to take my own cue off the big US market. It's not always right to do that, but I think in terms of getting a benchmark and some sort of a feeling for world markets, then I tend to look at the US. My own view would be, having done calculations, and I have a model that I use, it's a very simple one, but I feel the US equity market is probably some 15–20% overvalued relative to long-term norms. Now, if you ask me whether the market is overvalued relative to bond yields, which is your alternative asset, then I would struggle, because the market isn't overvalued relative to bonds. But in absolute terms, which I think is safer ground, I think the market is probably a little bit ahead of events. I think corporate earnings in the US are at a peak, which is highly unusual and doesn't normally sustain itself, which means to me the corporate earnings could easily come under pressure in the next year or two. In Ireland, I'm a big fan of CRH. I think as a deep value stock, I think it's excellent. You can buy CRH at the same price that management has put the assets together over 30 years. You're paying an enterprise value that equals the share price, and that's unusual for CRH because it is normally a very profitable company. Obviously, its profits are under pressure because of the unusually long nature of the downturn in construction, but that too will pass. And I think if you buy at current levels, this is a world-class company with a great spread of business and a reasonable management team. And I think its balance sheet is not under any pressure, so you've got time in your hand. And so in Ireland, I think CRH is great value. I don't know the timing of the recovery in the share price. Abroad, when I look into the US, I'm very attracted to the US global franchise stocks. The Coca-Colas, the Johnson & Johnsons, the Walmarts, the McDonald's, the Kellogg's, the Krafts, Procter & Gamble's, as a bunch of companies. If I put 8 of those companies together, I can buy them on a historic PE ratio of 15 at the moment, with a yield of 3%. And the resilience that is attached to their earnings is unparalleled. And at the moment, if I bought the S&P 500, I would be paying 14 times historic earnings, and their peak earnings. So I believe the proposition on offer in defensive companies that can grow is very unique. In fact, to be able to get those 8 companies that I mentioned together as a basket for a PE of 15, you haven't been able to do that since 1989. And in 1989, interest rates were 8% in the US, and they're not 8% today. So I think there's great value in those franchises. Well, I think when you look back to 2000, they were as overvalued as anything else. So they spent 10 years correcting their overvaluation. In the preceding 10 years, in the subsequent 10 years, their earnings have continued to grow in an uninterrupted manner, despite the two savage recessions that came, the early 2000s and the later 2000s. So they've been doing, as companies, they've been doing what they've been doing. And they've been growing their dividend, growing their earnings and cash flows. It's just the market overpaid. By the late 1990s, they were overvalued. You were paying 35 times every dollar of earnings. Today, you're paying 15. So it's a case of when, in that long-term, sort of long drift down in valuations, that secular bear market, as you might call it, in a particular area of the market, I think it's over for these global franchises. I can't see why you are being offered a PE of 15, which if you flip that on its head for a retail investor, that's a yield, an earnings yield of 6.5%, if not more. And because these are defensive companies with reliable earning streams, that's a bond-like income that's growing. So why should you be able to buy them at double the bond yield? Back in 1999, the same equation worked the other way. The bond yield was offering you a 6.5% 10-year yield to redemption, where the global franchises were offering you an earnings yield of 3.3. So it's just flipped over. It takes a long time for the market to come back into favour for a certain area. In the last 2 years, the market has been busy re-rating and rebuying the cyclical stocks, or the economically sensitive stocks that got absolutely killed in the downturn. And the global franchises have improved, their share price has gone up, but they've just got left behind a bit in terms of the recovery that's been on offer elsewhere. But as I said, corporate earnings in the US is now at near an all-time peak. So to me, cyclical stocks dependent on the economy is where the risk is. It doesn't lie in these franchises. Well, if people are trying to find me, the investor centre is investorcentre.com. You just drop the O, it's investorcentre.com. And I do a weekly, I do an audio, and if you're trying to get used to me and my service, then there's a free weekly email we do. You can just pop in your email address to the website and you can get a free weekly while you're getting used to the service, and then decide to subscribe or not.